the other issues. Now let us come to the definitions part. What is property, plant and equipment? It is a tangible item which is held for use in production of goods, provision of services, or held for giving it on rent to others or for administrative purposes. But specifically, please remember, if you are holding land and building only for giving it on rent to others, it's not used for your business purpose. In such cases, it is not a PPE. It is covered by Indas16 investment property. If you are holding a building for administration purpose, that building is PPE. If you are having a machinery for production of goods, it is PPE. But if you are going to give that machinery on rent to others, then also it is PPE. Building held for business use, PPE. Building held for giving it on rent to others, investment property. Machinery used for production of goods, PPE. Machinery which is held for giving it on rent to others will still be considered as PPE. Okay. And the more important point is we expect to use them for a period of more than 1 year. So there are 2 points. They should be held for production of goods, provision of services, administrative purposes or for rental to others, and they should have an expected life of at least more than 1 year. So such tangible items are considered as property, plant and equipment. Intangible items are not covered by the standard. This is a specific standard Indas16 which deals with intangible assets. They are not considered as property, plant and equipment. Next, bearer plants. We have already learned about bearer plants. These are living plants or living trees which can bear produce for more than one accounting period. Example, you have mango trees, they can give produce for more than 1 year. You have rubber trees, they can generate produce for more than 1 year. You have coconut trees, they can bear produce for more than 1 year. Apple trees, vineyard, they are all called as bearer plants. They are not going to be, the trees are not going to be sold as an agricultural produce. The produce from the trees is going to be sold as agricultural produce. Okay, such plants are called as bearer plants. Next, carrying amount. What is carrying amount? It is the amount left after subtracting accumulated depreciation and accumulated impairment losses. So how do we arrive at carrying amount? It is historical cost minus accumulated depreciation, accumulated impairment losses, or revalued amount minus accumulated depreciation and accumulated impairment losses is considered the carrying amount. It is the amount left after subtracting accumulated depreciation and accumulated impairment losses. In our old language we call it as WDV, written down value of an asset. Now what is cost? Cost is the cash paid to acquire the asset or cash paid to construct the asset, or it also includes the fair value of other consideration paid to acquire the asset or to get the asset constructed. That is considered as cost. Next, residual value. What is residual value? Now, residual value is required for the purpose of calculating depreciation. So as per the standard, residual value is the amount which the management currently expects to receive if the asset is sold, but in the condition it would be at the end of its useful life. So what we have to assume is, suppose I have acquired a machine today, I have to estimate what is its useful life. So I would have to estimate what will be the condition at the end of its useful life. Suppose I have an asset which has reached the end of its useful life today and it is in that condition which it would be after 10 years. What will I receive today by selling it? That is called as residual value. So the amount which the entity expects from disposing the machine in the condition in which it would be at the end of its useful life today would be considered as residual value. Suppose I have acquired a machine today. It has a life of 10 years. So I would have to estimate after 10 years what would be its condition. Suppose I have a machine today of that condition. If I sell it, what am I going to get? That is considered as residual value. Okay. Next, depreciable amount. What is depreciable amount? Depreciable amount is cost minus expected residual value. That is the amount which I have to write off over the useful life of the asset. Or revalued amount minus residual value. This is the amount which I have to write off over the useful life of the asset. That is called as the depreciable amount. Now, depreciation. What is depreciation? The definition of depreciation is different when compared to accounting standard 6. The definition of depreciation as per this standard is, it is systematic allocation of depreciable amount of an asset over its useful life. Let us say the cost of the asset was 100 and the residual value is 20. That means if I sell the asset today, once it reaches, suppose I have the asset in the condition in which it would be at the end of its useful life. Today I can realize 20. So this 100 minus 20, 80 is the loss that is going to occur over the useful life. This loss of 80 has to be allocated systematically over the useful life. That systematic allocation of depreciable amount over the useful life of the asset is called as depreciation. Okay. Now let us come to the next part. Entity specific value. What is entity specific value? It is present value of cash flows which are expected to arise from use of the asset and also disposal value. That means if the life of the asset is 10 years, during this 10 years, what is the cash am I going to get by using the asset? Their present value. And also after 10 years when I sell the asset, what am I going to get? Its present value. The sum of it is called as entity specific value. Then we come to a very important term, fair value. Fair value determination is covered by a separate standard, Indas 113. Fair value can be equated to market value. Now, what is fair value as per Indas16? It is the price that would be received to sell an asset or the price which would be paid to transfer a liability in an orderly transaction between market participants on the transaction date. So on a specific date, in an orderly transaction, the price at which I would sell the asset or the amount which I have to pay to transfer a liability to the other party, such amount is called as fair value. Detailed prescriptions of how to determine fair value are given under Indas 113. So normally we are talking about market values. Okay. Next, recoverable amount. What is recoverable amount? Recoverable amount is higher of two numbers. One, value in use or fair value less cost to sell. So a company has to estimate for a machinery what is the value in use. Value in use is nothing but present value of cash flows which are going to be earned from using the asset and also the residual value. So it is present value of all cash which I am going to receive when I use the asset plus also the disposal value of the asset, their present value. That is called as value in use. Then I have to compare this value in use with fair value less cost to sell. What is the market price today? Subtract cost to sell. That means the net disposal value today. Whichever is higher would be considered as the recoverable amount of the asset. See, recoverable amount of the asset is nothing but it's a very simple concept. See, when I incur some cost on an asset, I expect to recover the cost either by selling the asset. So if I want to recover my carrying amount, I have to either sell the asset or use the asset. Either of the ways I can recover my carrying amount. So recoverable amount is higher of what am I going to get if I use the asset and what am I going to get if I sell the asset today. So higher of the two will be considered as recoverable amount. Then we come to impairment losses. Even though the standard does not give prescriptions for accounting for impairment loss, but we'll still understand what is impairment loss. When the recoverable amount of the asset is lower than carrying amount, the carrying amount, that is a book value, is higher than the recoverable amount. Recoverable amount is the amount I may get either by selling the asset or by using the asset. If it is lower than carrying amount, that means I have incurred more and I am going to recover less. In such cases, I am going to suffer some loss. Such loss is called as impairment loss. So when the recoverable amount of an asset is below carrying amount or when the carrying amount of the asset exceeds recoverable amount, we say that the asset is impaired. Such the difference between the recoverable amount and the carrying amount is called as impairment loss. Accounting treatment is prescribed under Indas 36. Next, useful life versus economic life. Now what is this useful life and economic life? An aircraft may have a total life of 10 years. That means according to the manufacturer of the aircraft can be flown. It can be used for a period of 10 years totally. But the aircraft company which has purchased that aircraft, they may have a policy of using the aircraft only for first 5 years and after that they want to dispose it off. So economic life is the total life for which the asset can be used. Useful life is the period over which the entity expects to use the asset, or it is a number of units which the entity expects to produce by using the asset. Useful life can be equal to economic life or useful life can be below economic life, but useful life cannot be more than economic life. Economic life is a total life. Useful life is out of the economic life, for how many years I am going to use it. The entity is going to use it. That is called as useful life. So for the aircraft company, even if the total life of the aircraft is 10 years, they have a policy of using it only for 5 years and then selling it. So this 5 years is called as useful life. The depreciable amount of the aircraft, that is cost minus estimated residual value. Now when we estimate residual value for such aircraft, we are not going to consider the condition of the aircraft after 10 years. We are going to consider the condition of the aircraft only at the end of 5 years. That means for this company who are taking the life as less than 10 years, the estimated residual value will be more. If the life is considered to be 10 years, if I am going to use it for 10 years, estimated residual value will be less. So depending upon the useful life, the residual value may increase or decrease. So the company will depreciate the asset only over a period of 5 years. So there is a difference between useful life and economic life. So we have covered all the definitions. Now let us come to the recognition part, para 6. Now what is para 6? As per the standard, when can I recognize property, plant and equipment as an asset in my books? This is the question. What constitutes an item of property, plant and equipment? As per para 6, two conditions have to be satisfied. Condition number 1, condition number 2. So before you record an item of expenditure as an asset in your books, what are the conditions to be satisfied? 1, probable benefits. So it should be probable that in future economic benefits will flow from the asset to the entity. That means more likely than not. In the economic conditions which we can estimate, the asset is going to generate economic benefits for us. So there should be a probability of economic benefits flowing to the entity. We can say probability of benefits. Second, cost of the asset should be measurable reliably. You should be able to measure the cost of the asset reliably. So when these two conditions are satisfied, an expenditure can be recognized as an asset in our books of account, para 6. Now, in the old accounting standard 10, there was no recognition criteria. It was assumed that fixed assets are going to generate benefits for us and they were capitalized in our books of account. But Indas 16 does not assume anything. It says you have to demonstrate that this expenditure will generate me future economic benefits. Second, cost can be measured reliably. When these two conditions are satisfied, only then it can be recognized in our books of account as an asset. Now we come to the next item, major spare parts standby equipment. Now as per the standard, we have to apply the recognition criteria even to major spares standby equipment. If they satisfy the definition of property, plant and equipment, then in such cases they can be capitalized in our books of account. If they do not satisfy the definition of property, plant and equipment, they have to be considered as inventory and they are dealt by Indas 2. So when we are talking about general spares, small spare parts, loose tools, which can be used interchangeably on any machine, such spares will be considered as raw material or they will be considered as inventory as per Indas 2. Specific spares, big motor which can be used only on one particular machine, cannot be considered as a general spare. It will be capitalized as an asset. Standby equipment, you are involved in power generation business. You have one turbine which is in operation and you also have a standby turbine. That means if there is a temporary breakdown of this turbine, immediately the other turbine will kick in. So now this turbine satisfies the definition of property, plant and equipment, will be considered as a part of property, plant and equipment. Okay. Next, unit of measure. What is this unit of measure? What item constitutes property, plant and equipment? So when can an item be considered as property, plant and equipment? Unit of measure is not defined by the standard. The management has to judge. The management has to lay down a criteria for deciding whether an item is an item of property, plant and equipment. The standard has not defined it. Sometimes individual items will satisfy the recognition criteria. That means they are capable of generating economic benefits for the entity. Cost can be measured reliably. Individually they can be capitalized. Sometimes individually an item may not satisfy the definition, but group of items like small molds, tools, dies, sometimes these items cannot satisfy the definition of a property, plant and equipment individually. Then they are grouped and the recognition criteria is applied to the group together. So sometimes the unit of measure can be individual items, sometimes the unit of measure can be group of items. Okay. Next, we come to the next issue. Cost incurred initially, subsequently, additions, replacements, servicing of parts. Now, when I incur some cost initially to acquire an asset, whether to capitalize it or not, we have already discussed. Now, if I subsequently incur some cost, that means I have already capitalized the asset in my books, I am incurring some subsequent costs. What should we do with those subsequent costs? Subsequent costs related to additions. We are making some additions. We are constructing an additional room on a building, or we are constructing an additional roof on a building. We are putting one more slab. Replacements. We are removing parts of an equipment, replacing it with new parts. We are removing an old engine, we are including a new engine. We are removing an old motor, we are including a new motor. Servicing of parts. We are repairing some parts. So how to deal with this expenditure? Whether it is initial expenditure or subsequent expenditure, whether we can capitalize it or not, the criteria is the same which is covered by para 6. So for initial expenditure or subsequent expenditure, before you capitalize, you have to apply para 6. Normally, subsequent expenditure, whenever the benefit is enhanced, the benefit which I am going to get because of subsequent expenditure, if it is more than what I was getting earlier, we can definitely add it as part of cost of the asset. That means whatever it is, whether it is initially or subsequently, you have to apply para 6. Okay. Now, equipment for safety and safeguarding of environment. Suppose an entity has installed certain equipment for safety purposes. Firefighting equipment, which is for safety purpose. Safeguarding environment, to save the environment from pollution, we have installed some pollution controlling equipment. Now this equipment, what should we do? According to the standard, they have to be capitalized, because without these assets, other assets cannot generate benefits for us. Without installing fire equipment, we may not get permission to use the factory. That means even though your factory is ready for use, without firefighting equipment, you may not get permission to first use the factory. That means without this, economic benefits will not flow to the entity. Then pollution control equipment, again, without this equipment, your license may be cancelled. Hence, without this equipment, it is not possible to generate benefits. Hence, these equipment indirectly are helping us to generate economic benefits. Hence, they should also be capitalized. Whenever we check for impairment, these assets should be clubbed with other assets, and then they should be checked for impairment. That is a requirement of the standard. So, if you have some fire safety equipment, equipment for safeguarding environment, these equipments cannot be checked for impairment individually, because they are not capable of generating benefits individually. They should be clubbed with other assets, and then we have to apply the impairment principles to all the assets together. Okay. Next, day-to-day servicing cost. If I am incurring some cost on labor, consumables, small spare parts for regular repairs of the machinery, what should I do? According to the standard, cost of day-to-day servicing cost should be debited to P&L, because these are costs incurred to preserve the operating capacity of the machinery. It is not for enhancing. If this servicing expenditure is incurred for enhancing the capacity, then definitely you can capitalize, or else no, you have to debit it to profit and loss account. Next, replacement of part. This is something very, very important, and this is something which is very new as well. Now, let us say you have a very big machine, and the machine has a very big motor, a heavy duty motor, not of a small size, not of the size which we use at our home. So we have a huge motor in that machine. Now the motor is not working properly. We remove the motor and we install a new motor in its place. So what should be the accounting treatment? So we are replacing a major component, we are replacing a major part with a new part. So what the standard says is, find out what is the WDV of the motor, remove it from the cost of the asset, include the cost of the new motor as part of cost of the asset. Similar example, you are removing the old seats in an aircraft and you are installing new seats. So in such case, what standard says is, find out what is the WDV, or what is the carrying amount of the old seats, remove it from the cost of the asset, include the cost of new seats as part of cost of the asset. So this is the prescription of the standard. The company is removing the old walls and then they are building new walls in the building. The WDV of the old wall should be removed, and then the cost of the new wall should be included within cost of the asset. So this is how the standard says you have to deal with replacement of parts. Then we come to bearer plants. Now we said bearer plants, apple trees, vineyards, lemon trees, mango trees, they are all considered as bearer plants. They are covered by Indas16. So what would be cost for these plants? They are like equipment. So what standard says is, till the day they reach the maturity age, whatever cost is incurred to grow this plant, this tree, has to be capitalized. And once they reach the maturity stage, capitalization should stop. And then whatever cost has been incurred to grow the tree has to be amortized over its useful life. This is what the prescription of the standard is. So up to maturity age, you can keep adding the cost incurred, you can keep capitalizing the cost which has been incurred for growing these trees, and the day it reaches maturity, stop capitalization, and then you can amortize or depreciate the depreciable value of the asset over its useful life. Next, we come to asset purchased on deferred payment basis. Now, suppose asset has been purchased on deferred payment. What is deferred payment basis? Extended periods of credit or installment system. If I purchase an asset on extended periods of credit, definitely the purchase price would be more than the cash purchase price. So what the standard says is, find out what is the purchase price under deferred payment system, what is the purchase price under cash basis. The difference would be considered as interest cost and debited to P&L account. The asset will be recognized at its cash cost. But suppose Ind AS 23 permits, then the interest cost can also be capitalized as part of cost of the asset. So general prescription is the difference between the deferred payment purchase price and the cash price. The difference is considered as interest cost. It should be written off to P&L account. But if Ind AS 23 permits, then definitely it can also be added as part of cost of the asset. So this is how you deal with assets purchased on deferred payment basis. Now we come to the next issue, major inspection costs. Now there can be certain situations where an asset can be operated only if an inspection is done. Now the condition of using the asset could be that the asset has to be properly inspected. A major inspection has to be done before you are permitted to use the asset. And sometimes the inspection may lead to replacement of certain parts, or they may not lead to replacement of parts. Whether it leads to replacement of parts or not need not be investigated. Sometimes major inspection costs are incurred to use the asset. So what standard says is, the inspection cost should be capitalized as part of the cost of the asset, and if there is any inspection cost which was incurred earlier, which is still part of the carrying amount of the asset, that has to be removed. So if you have carried inspection costs 3 years ago, if there is any unwritten amount, if there is any amount which has not been written off yet, which is still part of cost of the asset, remove it, and cost of inspection which you are incurring now can be added to the cost of the asset. Okay, this is the description of the standard. Now we come to the last two issues. One is incidental income. Now suppose I am constructing a building on a vacant site. Now for the building construction to commence, there is, let us say, a 2 to 3 months time which is still left. That means we have applied for permissions, and before the permissions come, we feel that at least 2 to 3 months the site will be vacant. And during this vacancy period, we have given that site for we can say parking facility, and some other entity has taken that site for parking facility, and they are paying us some parking charges. They are giving us some rental income. So this rental income cannot be subtracted from cost of construction of the building, because giving the site on for parking is not a part of the construction process. This is not related to construction activity. This activity of giving the site on rent to others is unrelated to construction activity. Hence, the income generated cannot be added to cannot be subtracted from the cost of the asset. If any expense is incurred, that expense and this income should be shown in P&L account. They should not be subtracted from cost of the asset. So this is what the standard says with respect to incidental income. So if any activity is carried out which is not done in the course of constructing the asset, that means the activity is not related to construction of the asset. If this activity is generating any income, that income cannot be separated from the cost of the asset. If any expense is incurred, that expense and that income should be shown separately in the P&L account as per relevant classification. Okay. And then we come to the last item, asset acquired in exchange. I have acquired an asset by exchanging another asset. Now, what standard says is, if you have acquired an asset by exchanging another asset, if one of the two conditions are satisfied, the asset acquired can be recognized at its fair value. Now, what are those two conditions? The first condition is, the exchange transaction should be having some commercial substance. That means, if anybody sees this transaction, they should feel that yes, it is a commercial transaction. The transaction should have commercial substance. And second thing is, at least the fair value of the asset received should be determinable, or the fair value of the asset given up should be determinable. Fair value of either of the assets should be available. If one of these two conditions is satisfied, definitely we can measure the asset acquired at its fair value. So before I proceed further, if I am exchanging an asset, I am giving up an asset and taking an asset, I want to determine the value at which I can recognize the asset. I want to show it at fair value. Standard says any of the two conditions have to be satisfied. One, the transaction should have some commercial substance to it. Second, either the fair value of the asset received should be determinable or fair value of the asset given up should be determinable. If any one of these two conditions satisfied, definitely yes, we can recognize the asset acquired at its fair value. Now here again there are two rules. Asset acquired should be recognized at fair value of the asset given up, or asset acquired should be recognized at fair value of asset received if it is more clearly evident. So if I am giving up an asset, if its fair value is available, that fair value will become the fair value of the asset acquired. Or if fair value of the asset acquired is more clearly evident, then that amount will be considered as the fair value of the asset acquired. So we will take fair value of the asset given up as fair value of the asset acquired, but if fair value of the asset received is more clearly evident, then that would be considered as the amount at which we are going to capitalize the asset. Suppose those two conditions are not satisfied. I said to recognize the asset when you are acquiring an asset by exchanging, to recognize the asset at fair value, any of the two conditions have to be satisfied. That is, one, the transaction should have commercial substance. Second, either of the assets fair value should be determinable. If both the conditions are dissatisfied, they are not being satisfied. That means the transaction do not have commercial substance. Second, we are not able to determine fair value of the asset received or fair value of the asset given up. In such cases, what the standard says is the WDV or the carrying amount of the asset given up will become the cost of the asset acquired, plus cash paid if any, minus cash received if any. So if you are giving up an asset, it's WDV, and if you have paid some cash also, add both of them to arrive at cost of the asset acquired. You have given up an asset, WDV, and you have received some cash along with the asset, then WDV of the asset given up minus cash received. The difference will be considered as part of cost of the asset. So if those two conditions are not satisfied, according to the standard, WDV of the asset given up will become the fair value of the asset acquired. But sometimes along with the asset we may give some cash as well, so both have to be added. Sometimes ulta can also happen. We give up an asset, we receive an asset, and we also receive some cash. Then WDV of the asset given up subtract cash would become the fair value of the asset received. So in this lecture we understood what constitutes cost of an asset in various circumstances. We discussed various definitions, and we discussed what can form part of cost of the asset, what cannot form part of cost of the asset. Thanks a lot.